Here is an interesting thought. Very often when buying an investment, so not just a short-term speculative thing, not just a thing that you flip in a week or two, you're buying an investment for several months, several years. Very often when you get in, the price does not look cheap. Very often you're not the first person that notices that a certain company is probably performing well. So there are already purchasers of, say, the stock of the cryptocurrency. When you're buying Tesla, for example, right when you bought Tesla in the somewhat early days, let's say 2 or 3 years ago. At that time, Tesla was already rallying a ton. So it wasn't necessarily super cheap. Or if you're buying, say, Apple stock, right? Apple is already going up a lot. If you're buying Google, if you're buying Microsoft, all of those prices look very high. Yet those stocks tend to be the ones that continue to outperform the most. So there is a case to be made for short-term speculations to buy whenever blood is in the street, right? Whenever times are depressed. And if you look at US dollar valuations, you might even sometimes see quite big drops in, say, Apple, for example. But when you look at the relative valuation of, say, a stock to, say, the index, so Apple divided by the Nasdaq, or, say, the altcoin divided by the Bitcoin price, and the fluctuations are much less extreme because we don't have the ups and downs of the overall market in the price. So we take out a lot of the systemic risk from the price movements. So systemic risk is what traditional finance calls these things. So there is a general ups and downs of the market that we remove by dividing by the index. And when we look at those prices of Apple or of Amazon or of Microsoft, Google, etc., we see that they appreciate with a relatively constant rate. And the drops aren't that big. Now, when an asset drops a lot, let's say Tesla, then usually there's also a reason behind this. So initially, a lot of momentum builds around a certain company, for example, or a certain crypto project, and people jump on this, right? Everybody gets hyped about this. When then that hype stops, so when then the outperformance suddenly stops, the reason why it stops is because obviously people that bought in early, they take some profit, but very often also what happens is that the general fundamental situation of the company has changed a lot. Because when you're buying into an asset, you tend to have confirmation bias, right? When you're buying something, you're looking for information that confirms your belief. So that's a very typical psychological effect. So when the market actually turns around on something that's currently bullish, that means that probably the situation is much worse than most people want to believe. Because then some people are taking profit despite their positive bias on the asset. So the people that hold an asset should be the most bullish on the asset. So what should happen as per tendency, especially in crypto, we see this, is that things go in waves. So whenever positive momentum picks up, it's more likely that the positive momentum will continue than that it will turn around. So you can actually measure this with statistical things like moving averages, where we tend to buy whenever price is above a moving average and we tend to creep up in price. There's a higher likelihood that the positive trend will continue than that it will turn around. That's simply just building the current momentum.
This video is sponsored by the Premium membership. I never take any money from any crypto project. I never take any affiliate links from centralized exchanges. I never pump and dump coins. Instead, I offer valuable tutorials in the Premium membership. Feel free to check it out.
So what that means is when you're jumping on an asset and you think that this asset might be very expensive, but you also feel like there's currently a lot of positive momentum around it and the fundamentals align, then this is totally fine. It's okay to buy high and sell higher. One does not necessarily have to buy low because very often trends do not turn around. When a company doesn't perform well, when a crypto project doesn't perform well, then nobody can say for sure that the team will suddenly wake up and become hyper-productive. It's more likely that the team that's hyper-productive will continue to be hyper-productive. And the best investments that I've personally made had been the investments that felt pretty bad at the time, that felt already expensive at the time. Of course, the better investments are the ones that are super, super depressed and everybody is simply just freaking out and you're buying anyway because you know the fundamentals, that they are positive. Those are, of course, the very best scenarios, but they don't happen that often. What happens, unfortunately, with beginners in investing in general is that they simply just buy something because it's low, but they don't necessarily buy this because they believe that much in the fundamentals of the asset. They simply just buy it because it used to be high in the past, now it's low, so probably it's going to be high some point in the future again. But most of the time, that's unfortunately not what's going to happen. It happens in very rare occasions, and ideally, you've got a very strong conviction when you do those kinds of contrarian moves, why you are right and the market is wrong, because most of the time the market unfortunately is right. Being right when most people are wrong is of course a very good strategy. But simply just joining the winners is a good strategy as well, because this is how any market works. Most profit is concentrated in just very few players. So this goes in all kinds of dimensions. This goes, for example, with assets within a market. So let's say most stocks underperform the average benchmark, and there's a few outperformers that outperform massively, that push up the entire benchmark. So if you just randomly pick a stock in a market, you're very likely going to underperform the benchmark. That's why people buy just the benchmark, right? The index ETF. So most stocks underperform the index, but you've also got that in trading. Most traders underperform the index. Most traders underperform the average trader. There's a few traders that get everything. And this totally makes sense, right? The winner takes most in pretty much any situation of life. So it can't just be slightly above average in order to win. You have to be among the top 10%, top 5%, and then you reap most of the rewards of the entire market. So that goes with investing. That also goes with employment, right? The management takes most of the salaries. That goes even with, like, say, the dating market, right? Just a few guys have options that are unlimited, and most guys are then fighting over the mediocre options, however you define mediocre in that case. And so being with the winners is a winning strategy. Being right when the market is wrong is an even better winning strategy, but it's incredibly hard to execute. I like to simply just follow the winners. So what I do in crypto, for example, is I track other influencers. I track other good traders. So I look at other traders that used to trade an asset very successfully, and I simply just see when are they buying and selling that asset. And then I tend to do the same. Or when I look at influencers, right, other YouTube influencers that might be promoting a certain crypto token in the future, I simply just follow those wallets. I look at when are they buying something, and then I try to anticipate when are they going to promote this on YouTube. And whenever that YouTube video hits, then the price, of course, goes up a lot, because then all the people are buying after the recommendation. So there is a real strategy to this, right? Don't just try to buy something because it's low, and don't just avoid buying something because it appears to be high in price. If the fundamentals are aligned and you believe that long-term that company will continue to outperform, if you believe that Google will continue to own the internet, right, they own search, they own YouTube, they own Android, if you believe that this doesn't change a lot, then probably it might make sense to buy Alphabet stock, even though it's not cheap. If you believe that Bitcoin will stay around, then probably it makes sense to buy now. If it drops further, then you can buy even more. So to keep a long story short, it simply just matters to buy the good stuff, pretty much independent of price. If you get a good price, even better. But if you get the average market price and it's not super hyped right now, then buying something that appears to be expensive is still fine as long as the long-term fundamentals stay the way they are. Try to focus on the few winners. Most people lose. Most stocks lose. Try to be very focused. Don't over-diversify. Don't own 40, 50 assets, because then most of the cases you will not do as well as just buying the overall index. Try to focus on the few winners that you believe will continue to outperform. It's probably going to be Google and Microsoft and maybe Nvidia. Probably not Tesla, who knows? There's simply just a lot of competition now for Tesla. Try to not reinvent the wheel. Try to not buy the obscure asset that crashed by 90%. Just because it was high in the past doesn't mean that it will be high in the future again. If it's your first time here, feel free to subscribe. I publish this regularly. Like would be very much appreciated as well. Helps the channel grow. And feel free to join us in Telegram. There is a Telegram link down below. Looking very much forward to chatting with you over there. See you there. Cheers.